When people talk about California's housing crisis, they talk about San Francisco. They talk about Los Angeles. They talk about coastal affordability, tech sector displacement, and the exodus of residents to Texas and Florida. They almost never talk about what is happening to the rest of California. There are 58 counties in the state. The national conversation focuses on 3 or 4 of them. The remaining 54 exist in a media blind spot so complete that the structural deterioration building inside several of them has been compounding for years without generating a single mainstream headline. Today we are focusing on 7 of those counties. 7 California counties where a convergence of economic stagnation, insurance market withdrawal, population decline, fiscal distress, and housing market dysfunction is creating conditions that directly affect the equity, yield, and long-term asset protection of everyone with property exposure in these markets. Here is something most people completely overlook. The most financially dangerous real estate situations are not the ones making headlines. They are the ones building quietly in markets that nobody is watching. By the time a crisis becomes visible enough to generate national coverage, the optimal window for protecting your position has already closed. These 7 counties are at different stages of that process. Some are in early deterioration with leading indicators that most buyers and owners have not yet absorbed. Others are already past the point where deterioration is visible in transaction data but where the full consequences have not yet been priced in. And at least one is in a category that should alarm anyone currently holding property there regardless of what the official appraisal says. There is a single underlying mechanism connecting all 7 counties on this list despite their geographic and economic differences. I will identify it precisely as we work through each county. But I want you to hold a question in mind as we move through this breakdown. Why are these particular counties being overlooked when the data is publicly available and the warning signs are clearly visible to anyone who looks? The answer to that question tells you something important about how real estate risk gets mispriced in regional markets, and how that mispricing creates both danger for unprepared owners and opportunity for informed capital. The framework. What qualifies a county as a quiet crisis? Before we get into the specific counties, the analytical framework matters. A quiet crisis is not simply a market where prices are flat or where growth is slower than the state average. It is a market where multiple structural indicators are deteriorating simultaneously in ways that compound each other, creating a feedback loop that becomes self-reinforcing once it reaches a certain threshold. The 5 indicators we are tracking across each county are population trajectory, which tells us whether the demand base is growing or contracting. Insurance market access, which determines whether properties can be financed and maintained at current cost structures. Fiscal health at the county and municipal level, which affects infrastructure, services, and the tax burden on remaining residents. Employment-based diversification, which measures how vulnerable the local economy is to a single sector disruption. And housing market liquidity, which tracks whether transactions can clear efficiently and whether buyer pools are deep enough to support current valuations. You might think that California's overall economic scale insulates its individual counties from serious structural decline. But the reality is that California's economic power is extraordinarily concentrated geographically. The Bay Area and Los Angeles Metro together account for a disproportionate share of the state's GDP. The counties outside those corridors are operating in a fundamentally different economic environment, and several of them are doing so with deteriorating fundamentals that their surface-level home price data does not currently reflect. With the framework established, let us get into the counties. We are moving from the most advanced stage of quiet crisis to the one that is closest to the beginning of a deterioration cycle that most current owners in that market are completely unprepared for. County number 7, Tulare County, the agricultural economy trap. Tulare County sits in the heart of the San Joaquin Valley and contains some of the most productive agricultural land in the world. Its farms produce a staggering share of the nation's dairy, citrus, and table grapes. For decades, this agricultural productivity created a stable if modest economic foundation that kept the county's housing market functional even as surrounding areas experienced volatility. That foundation is now under pressure from multiple directions simultaneously. Water availability in California's Central Valley has become one of the defining economic variables of the current cycle. Groundwater overdraft in the San Joaquin Valley has reached levels that have triggered mandatory cutbacks under the state's Sustainable Groundwater Management Act. Farms that have operated for generations on groundwater access are facing restrictions that threaten their operational viability. When agricultural operations contract or fail, the employment and income base of the surrounding community contracts with them. Here is something most real estate buyers in Tulare County have not fully processed. When the primary economic engine of a county is under structural constraint from water regulation, the effects on housing demand are not theoretical or distant. They are direct and measurable. Fewer farm workers employed means fewer households renting or buying. Lower farm revenues mean less business activity in the surrounding service economy. The transmission from agricultural stress to housing market weakness is faster and more complete in a mono-industry county than in a diversified one. Poverty rates in Tulare County are among the highest in California, consistently ranking in the top tier of the state's most economically distressed counties. Median household income sits well below the state average, creating an income-to-price ratio that limits organic housing demand and caps natural appreciation potential. The buyer pool for housing in the county is thin and income-constrained, making the market highly sensitive to any deterioration in the agricultural employment base. For investors seeking yield through affordable residential rentals, Tulare County presents apparent numbers that look attractive on a spreadsheet. The on-the-ground operational reality, including higher vacancy risk, higher maintenance costs relative to rent rolls, and limited exit liquidity, requires a more rigorous underwriting approach than the gross yield figures suggest. Tulare County's crisis is rooted in a single industry under structural constraint. The next county on this list faces the same single industry vulnerability but with an added layer of regulatory and transition risk that is accelerating the timeline of its economic adjustment. County number 6, Kern County. The Energy Transition Reckoning. Kern County produces more oil than any other county in California. The county around Bakersfield has been the engine of California's petroleum industry for over a century. And the economic identity of the region is inseparable from the energy sector that employs a significant share of its workforce and generates a substantial portion of its tax base. California has committed, through legally binding legislation, to phasing out new oil and gas drilling permits and accelerating the transition away from fossil fuel production. The timeline of that transition is a matter of active regulatory and legal debate. But the direction is not in dispute. Kern County's dominant industry is facing a managed wind down within the state's own regulatory framework. Stop and consider what this means for property values in a county where a significant share of high-wage employment is tied to an industry that the state has committed to transitioning away from. This is not a cyclical oil price correction of the kind Kern County has weathered before. It is a structural shift with a policy-driven timeline. The difference between cyclical and structural in real estate terms is the difference between a market that recovers when conditions change and one that requires a fundamental economic reinvention before it can recover. The county has been working to attract replacement industries and has had some success in renewable energy, particularly solar and wind development in the Mojave Desert portions of the county. But the wage levels, employment density, and economic multiplier effects of renewable energy construction and operation are materially different from those of petroleum extraction. The transition, even in the most optimistic scenario, involves a period of net economic contraction before any replacement growth can compensate. Housing market indicators in Kern County reflect this structural uncertainty. Days on market have been trending upward. Price growth has lagged the state average for several consecutive cycles. And the buyer pool in the Bakersfield Metro, the county's population and economic center, is showing the income constraints that accompany an economy in sector transition. County number 5, Butte County. The post-disaster insurance crisis. Butte County's quiet crisis has a specific originating event. The Camp Fire of November 2018 was the deadliest and most destructive wildfire in California history, destroying the town of Paradise and killing 85 people. The physical reconstruction of the affected areas has progressed over subsequent years. The insurance and financial consequences of that event are still actively reshaping the county's housing market in ways that most current buyers and property owners have not fully internalized. Following the Camp Fire, multiple major insurers began reassessing their wildfire exposure across California. Butte County, given its demonstrated catastrophic loss history, became one of the first markets where non-renewal of homeowners' policies became common rather than exceptional. The practical consequence is that a growing share of properties in the county can only obtain coverage through California's FAIR Plan, the state's insurer of last resort, which offers more limited coverage at higher premiums than standard market policies. Here is something most people completely overlook about the insurance crisis in fire-affected California counties. When a property can only be insured through the FAIR plan, lenders who require standard policy coverage as a condition of mortgage financing face a compliance gap. In some cases, this has resulted in lenders declining to originate or refinance loans on properties that cannot obtain standard coverage. A market where mortgage financing becomes selectively unavailable is a market where the effective buyer pool has contracted regardless of what headline demand numbers suggest. The rebuilding of Paradise and surrounding areas has attracted residents who are either unaware of or are choosing to accept the ongoing insurance and wildfire risk. For these buyers, the risk-reward calculation requires a level of explicit underwriting that most residential transactions do not typically involve. The county has genuine rebuilding momentum, and some areas present genuine value for buyers who understand and accept the risk profile. But that same risk profile creates structural constraints on the depth and sustainability of the buyer pool that will affect resale liquidity for years. The insurance thread connecting multiple counties. You have now seen insurance market withdrawal appear in 2 of the first 3 counties on this list. This is not coincidence. It is the single underlying mechanism I referenced at the start of this breakdown that connects all 7 counties despite their different economic profiles. The specific trigger varies by county, but the consequence is consistent. When insurance becomes unavailable, unaffordable, or structurally compromised, property values in affected markets face a constraint that no amount of demand can fully overcome. I will show you exactly how this plays out in its most advanced form before this breakdown concludes. County number 4. Shasta County. Political instability and institutional erosion. Shasta County in Northern California presents a housing market risk that is less common in real estate analysis but increasingly relevant in the current environment. The county has experienced significant political instability at the local governance level over recent years, including a recall of elected supervisors and ongoing governance disputes that have created institutional uncertainty affecting county services, planning processes, and the broader investment climate. Political instability at the county level is not merely a civic concern. It has direct financial consequences for property owners through its effects on zoning and permitting processes, infrastructure maintenance prioritization, and the county's ability to attract and retain the institutional employers that provide stable employment and housing demand. You might think that local political disputes in a rural California county are too contained to affect property values in any meaningful way. But the reality is that institutional quality is one of the most durable drivers of long-term property value. Counties with functional, predictable governance attract investment and retain residents. Counties with governance instability create uncertainty premiums that are reflected in both transaction velocity and price levels. The effect is gradual and easy to overlook in short-term price data, but it compounds over time in ways that become very difficult to reverse. Shasta County also faces the demographic pressures common to many Northern California counties. Population growth has been stagnant. The working-age population has been drifting toward larger metros with broader employment options. And the county's economic base, historically anchored in timber, agriculture, and healthcare services for the regional population, has not attracted the diversification needed to retain younger households. Redding, the county seat and by far the largest city, has seen periods of genuine revitalization alongside persistent challenges with homelessness, public safety perception, and retail vacancy in its core commercial areas. These are the visible symptoms of the underlying demographic and economic pressures that affect surrounding residential property values through their effect on neighborhood quality signals that buyers process when making purchase decisions. County number 3, Lake County, the most vulnerable market in the state. Lake County occupies a unique and deeply concerning position in California's housing market landscape. It has one of the highest poverty rates in the state, consistently ranking among the lowest in median household income. It has been affected by multiple major wildfires in recent years, including the Valley Fire and the Mendocino Complex Fire, which destroyed thousands of structures and displaced a significant share of the county's population. And it is home to Clear Lake, the largest natural freshwater lake in California, which has been chronically affected by harmful algal blooms that limit recreational use and affect the environmental desirability of surrounding properties. The insurance crisis in Lake County is among the most severe in the state. Following repeated catastrophic fire losses, private insurance has become extraordinarily difficult to obtain for many properties. Fair plan coverage is now the primary option for a substantial share of homeowners, at premium levels that represent a significant carrying cost burden for a county where household incomes are already among the state's lowest. Stop and consider the financial architecture of this situation carefully. Low median household income limits the organic buyer pool. Chronic wildfire risk and insurance unavailability create carrying cost burdens that disproportionately affect lower-income owners. Environmental challenges at Clear Lake reduce the recreational value premium that lakefront properties typically command. And limited economic development prospects constrain the income growth that would normally allow a distressed market to gradually improve. These are not temporary headwinds. They are structural constraints that reinforce each other. For investors who have been drawn to Lake County by what appear to be extremely low entry prices and apparently high gross yields, the operational reality has consistently disappointed those expectations. Vacancy rates are high. Tenant quality is constrained by the limited income demographics of the available renter pool. Maintenance costs on older housing stock in a fire-prone environment are elevated. And exit liquidity, the ability to sell at a reasonable price in a reasonable timeframe, is fundamentally limited by the shallow buyer pool that the county's economic and risk profile produces. Lake County is not uninvestable under any circumstances for any investor, but it requires a level of localized knowledge, operational infrastructure, and risk-adjusted return discipline that general market buyers entering from outside the county rarely bring with them. County number 2, Madera County, the overlooked Central Valley deterioration. Madera County sits between Fresno and the entrance to Yosemite National Park, a geographic position that creates an interesting split personality in its housing market. The portion of the county adjacent to Yosemite and the Sierra Nevada foothills attracts second-home buyers and vacation rental operators drawn by recreational proximity. The majority of the county's population, concentrated in the city of Madera and surrounding agricultural communities, lives in an economic environment that has more in common with Tulare County than with the mountain resort markets of the Eastern Sierra. Madera County's poverty rate is among the highest in California. Educational attainment levels are below state averages, which correlate strongly with long-term income growth constraints and the ability of the local economy to attract higher-wage employers. The agricultural employment base faces the same water regulation pressures affecting Tulare County to the south, and the county lacks the economic diversification that would buffer the impact of agricultural sector contraction. Here is something most people completely overlook when evaluating Central Valley counties. The apparent affordability of housing relative to coastal California prices creates a perception of value that does not survive rigorous income-to-price ratio analysis. When you compare median home prices to local median incomes rather than to coastal California prices, the affordability advantage largely disappears. You are buying cheap housing in a market where incomes are also low, debt service capacity is limited, and the buyer pool depth necessary to support appreciation over a full cycle simply does not exist. The vacation property market in the eastern portion of Madera County presents a different risk profile but its own concerns. Vacation rental markets are dependent on discretionary travel spending that is sensitive to economic cycles. Insurance costs for properties in forested fire-adjacent areas of the Sierra foothills have been rising sharply. And regulatory risk around short-term rental licensing is a factor in multiple Sierra Nevada gateway communities that could affect the income model for investors who have purchased based on vacation rental projections. Into the final and most urgent county. The 6 counties we have covered represent a spectrum from moderate structural headwinds to severe multi-factor deterioration. But the county at the top of this list is the one where the convergence of all 5 crisis indicators is most advanced, most acute, and most likely to produce visible property value consequences in the near term for owners who are currently not pricing this risk into their financial planning. County number 1, San Bernardino County. Scale, exposure, and the risk nobody is pricing. San Bernardino County is the largest county by land area in the contiguous United States, larger than 9 individual states. Its economic and demographic profile is so varied across its geographic expanse that discussing it as a single market requires careful qualification. The western portions of the county, particularly the Inland Empire cities of Ontario, Rancho Cucamonga, and Fontana, have genuine economic momentum driven by logistics, warehousing, and their position as a distribution hub for the Los Angeles metro economy. The quiet crisis we are identifying in San Bernardino County is not in those western logistics corridors. It is in the vast eastern and mountainous portions of the county, including the Victor Valley communities of Victorville, Hesperia, and Apple Valley, the mountain communities of Big Bear and Lake Arrowhead, and the high desert areas that absorbed significant population overflow from Los Angeles during the pandemic-era housing boom. Here is the data point that should reframe how every San Bernardino County property owner in affected areas is thinking about their position. The pandemic-era migration into the high desert and inland empire was driven by a specific and temporary set of conditions. Remote work enabling households to trade commute access for space and affordability, mortgage rates at historic lows making the larger mortgage required for an inland purchase manageable, and a collective recalibration of lifestyle priorities that prioritized square footage over urban proximity. All three of those conditions have since reversed. Remote work has contracted. Mortgage rates have more than doubled from their lows. And the return-to-office pressure affecting Los Angeles-based employment is gradually unwinding the geographic flexibility that made distant inland living financially rational. The Victor Valley communities face a specific version of this reversal that deserves direct examination. These cities absorbed substantial population inflow during the boom years, driving rapid price appreciation that pushed valuations to levels that require either high incomes or low mortgage rates to sustain. Neither condition currently applies to the buyer pool available in these markets. Median household incomes in the Victor Valley are modest relative to the home prices that were established during the pandemic-era surge, and the mortgage rate environment has compressed the buyer pool further by increasing monthly carrying costs dramatically for anyone purchasing at current prices with current financing. The logistics and warehousing economy of the Western Inland Empire does not extend its employment benefits to the high desert in any meaningful way. The commute distances are prohibitive for daily travel. The employment base in the Victor Valley itself is anchored in retail, healthcare, and local services, none of which provide the income levels needed to sustain the pandemic-era price structure at current mortgage rates. You might think that San Bernardino County's size and diversity insulate it from serious market-wide risk. But the reality is that the diversity that protects the Western Logistics Corridor actually creates a false sense of security for owners in the eastern and high desert portions of the county who assume they are benefiting from the same economic tailwinds. They are not. They are in a fundamentally different economic micromarket that is carrying valuation levels established during an anomalous period and now facing a sustained demand test that those valuations may not pass. The insurance dimension adds further pressure specific to San Bernardino County's mountain communities. Big Bear, Lake Arrowhead, and the surrounding mountain areas have seen significant insurance non-renewals and premium increases following wildfire risk reassessment by major insurers. Mountain community properties that require year-round access, significant snow removal infrastructure, and specialized coverage for forest-adjacent risk are among the most difficult to insure affordably in California's current insurance market. The FAIR Plan exposure in these communities is growing, and the carrying cost implications for current owners are material. This is what I was pointing toward at the very start of this breakdown when I said there is a single underlying mechanism connecting all 7 counties. In San Bernardino County, as in Butte County, Lake County, and the Sierra-adjacent portions of Madera County, it is the insurance market withdrawal from fire risk properties that is creating a structural constraint on buyer pool depth, financing availability, and carrying cost sustainability. The mechanism is the same. The scale in San Bernardino County, given the population size of affected communities, makes it the most consequential expression of that mechanism currently visible in California's regional housing markets. The protection framework. What to do with this information? The 7 counties we have analyzed present a range of risk profiles and a range of appropriate responses depending on your specific exposure, timeline, and financial position. The framework for acting on this information has 3 sequential steps. Step 1. Exposure assessment. The first step is an honest accounting of your current exposure to the specific risk factors identified in this breakdown. If you hold property in any of the 7 counties, the relevant questions are precise. Is your property currently insured through a standard market policy or through the FAIR Plan? If FAIR Plan, what is the current premium and what coverage limitations apply relative to your property's replacement cost? What is the income-to-price ratio in your specific submarket, not the county average but the zip code level data? And what is the current days-on-market trend for properties comparable to yours in your immediate area? These are not questions that require professional assistance to answer, although professional assistance adds precision. They are questions that require deliberate research that most property owners never conduct because the absence of visible distress in their immediate environment creates a false sense of stability. Stop here because this is the most actionable point in the entire breakdown. The counties on this list are quiet crisis markets precisely because the surface indicators look manageable while the structural indicators are deteriorating. The homeowner who checks their Zillow estimate, sees modest appreciation, and concludes their position is fine is looking at a lagging indicator. The homeowner who checks their insurance renewal, their days on market data, and their income-to-price ratio is looking at leading indicators. Only one of those homeowners is making financially informed decisions. Step 2. Liquidity buffer calibration. If your exposure assessment reveals meaningful risk concentration in any of the counties or risk categories identified in this breakdown, the second step is calibrating your liquidity buffer to match the risk profile. A property in a market where insurance costs are rising, buyer pool depth is contracting, and days on market are increasing is a property that may require a longer hold period than originally anticipated before a favorable exit is achievable. The liquidity buffer calculation asks how many months of total carrying costs, mortgage, insurance, taxes, and maintenance combined you can sustain from accessible liquid resources if your primary income is disrupted or if a necessary sale takes longer than expected to complete. In high-risk markets, the standard recommendation of 3 to 6 months of liquid reserves is insufficient. A 12 to 18-month buffer is the appropriate target for property in a market where exit liquidity is structurally constrained. Step 3. Repositioning decision. The repositioning decision is the most consequential and the most personal of the 3 steps. It is the determination of whether your current position in an affected market is one you should hold, optimize, or exit based on your specific financial circumstances, investment timeline, and risk tolerance. For owner-occupants with low-rate mortgages and strong liquidity positions in markets where the deterioration is at an early stage, the lock-in economics of holding may well outweigh the structural risk. The carrying cost of your existing position at your existing rate may be considerably lower than the cost of an equivalent property in a less risky market at current rates. That mathematical advantage deserves to be weighed honestly against the structural risk. Here is the final truth that the entire framework converges on. The California counties facing quiet crises are not all equivalent in their urgency or their trajectory. Some are at an early stage where monitoring and liquidity management are the appropriate response. Others are at a more advanced stage where the window for a deliberate, planned exit at favorable terms is narrowing. The difference between those 2 categories is not visible in the headline price data. It is visible in the 5 structural indicators we have tracked throughout this breakdown. And the investors and homeowners who are reading those indicators honestly, rather than relying on the comfort of stable-looking surface prices, are the ones who will make the decisions that protect their equity before the quiet crisis stops being quiet. 7 counties. 5 structural indicators. 1 underlying mechanism connecting them all. The insurance market, the income-to-price ratio, the population trajectory, the fiscal health, and the employment diversification of these markets are telling a story that the median price data is not yet reflecting. That gap between what the structural indicators say and what the published prices show is the definition of a market where risk is being systematically underpriced. In every previous cycle, the investors and homeowners who recognized that gap before it closed preserved their capital and their options. Those who waited for the risk to become obvious in the price data paid the price of that delayed recognition with their equity. California's quiet crisis counties are sending clear signals right now. The question is simply whether the people exposed to those markets are listening.